New Year's resolutions for investors, led off by stop overtrading.
Well, yeah, I mean,
that kind of speaks to what we're doing now. I mean, you describe. I think we made a wall of what your New Year's resolutions are.
Let's see if we can get that on screen, guys, while Scott's talking.
Stop overtrading. Stop following the so-called smart money. Stop listening to charlatans. Stop trading the options, retail investors. Stop obsession over the macro. Explain.
So this is on downtownjoshbrown.com, which is my new website. And what I tried to do was think about some of the things that I had done wrong, if not this year, then in prior years. These are evergreen, but I think specifically overtrading applies to this year. This was one of those years where the less you did, probably the better off you ended up because of the nature of this year's rally. First, we had two distinct corrections. One of them was in March with the banking panic, and then the other one was August through October with that mini echo scare in interest rates. If you had ignored both of those two things and didn't feel the need to do a lot of trading around them, you're probably up double digits on the equity side of your portfolio right now. You got a NASDAQ going out plus 50%. You got an S&P going out plus 22%. And those were the two periods of time where we saw a ton of retail trading in the data. I want to touch on the options one, though, because I think this is really my biggest takeaway is that people are doing way too much of this. I'm not opposed to options, so don't write me letters. I'm not going to read them. I'm going to tell you something. 43% of daily options volume right now is being driven from zero-day expiration. 40%. That figure was 11% in 2019. In the last 4 years, we've brought in a new crop of retail traders. God bless them. I love them all. They are doing the wrong things with their money. This is obvious. Zero-day options grew to 17% of daily volume in 2020, then 21% the next year, 36% last year, 43% this year. Most of those trades are not helping anyone other than Ken Griffin. His boats keep getting bigger, guys. He's bought up all of Brickell. How much more money do you want to hand over? The last thing I would say on the option side, the way people lose money is there are three main reasons. First, they overpay for options relative to realized volatility. We know this from the data. It's not my opinion. Don't get upset about it. The second, they incur enormous bid-ask spreads. The typical percentage half spreads that retail traders are incurring, according to Vetify, is about 8%. Pros don't do that. Ask Joey T. He'll tell you. Nobody's making money doing that. The last is losses of 5 to 9% on average, 10 to 14% during high expected volatility announcements. What that means is trading options into earnings. So if you're doing that, understand most of that activity is benefiting someone else other than you. If you want to read the rest, you can hit my site.
Let's kick it around, Joe.
So I love all of these five, and I think one other thing that's so critically important is to have a process. People generally who endeavor into markets just go into the market and they don't have the process, they don't have the plan. And I'll use myself as an example of what I mean by that. A couple of weeks ago, I think it was on a Friday after Broadcom's earnings, I talked about trimming personally Broadcom. It was a horrible move. Where did that come from? That came from here. That came from the gut. That was my intuition. The process that I utilize is reflected in the quality momentum strategy. It didn't trim Broadcom, and look where Broadcom is today at 1141. So having the process, having a risk management strategy, always asking yourself first, where am I wrong? How much can I lose? Don't ask yourself, how much exactly is it that I can make?
I mean, let's take number 5, for example. We can show it, again, to remind everybody the list. Stop obsession over the macro. Now, Jenny, I think it's fair to say this year you could do nothing other than obsessed over the macro. You had to. I mean,
to her credit, she doesn't.
You're worried. No, but I'm just saying, like, as sort of generally speaking, you had to worry about it. You had to worry about, well, is this recession, this long talked about recession, going to happen because of all that the Fed's done? You had to worry about interest rates. You had to worry about more Fed hikes. You had to worry about, the rest of the world. You had to worry about China. You had to worry about wars. You had to worry about so many different things that made up the macro that inevitably didn't have as much of an impact on where we are today than many thought it would.
Right. And so I actually think, and I just wrote this in an email to a client this morning, I think when I reflect back on my career, this will be one of the 3 worst years I've ever had. And I don't mean in terms of performance, because performance is actually quite good for everybody at this point. But in terms of the mental duress that this year caused, because of that point exactly, Scott, to be able to stick with the strategy of managing a portfolio that's intended to generate a 5% dividend yield with capital appreciation on top of that, when everything's screaming in your face, everything you're doing is wrong, right? Because you're making good investments using the same process, the same philosophy that you always have, and the macro side is just saying you're wrong, you're crazy, you're wrong every day. It was as dark and miserable to manage a disciplined strategy in the same way that I've managed it for the past 20 years. The same thing with growth managers. The few growth managers out there who didn't turn into closet indexers in the last few years, and they were being told, oh, you're wrong because you're behind the benchmark. And I think that's probably, history will show that that's what will have separated the good portfolio managers from the weaker ones, those who were able to tune out the macro noise, because it was really, really, really hard. It was like horrible.
Last point, Steph.
I think you let the professional money managers do the trading and dealing with all of that, whether they trade a lot or they don't trade a lot. But I think the most important thing is you focus on fundamentals. And I go back to earnings. Now, this is the 3rd time I mentioned it, because earnings do matter. Eventually, it may not happen right away, but if earnings are going higher, stocks will follow. And when you have big drawdowns like we had in March and April of this past year, you're looking for quality on sale. They throw everything out and you find number 1 or number 2, best in breed, great fundamentals, and great balance sheets with free cash flow. And that's why you buy low and you sell high. And most people buy high and sell low.
All right.